Joining us now, UBS Alignment Partners Managing Director Alli McCartney. Thank you for being here, Alli.
Good morning.
So it's above the street median, but it's still only representing about a 4% upside this year. So are you expecting some choppiness to get to that level, or do you think things will be, at least in terms of equity volatility? We've seen some rates volatility in 2023, but equity volatility is...
Yeah, completely. But look, we've been talking about expecting more volatility for a very long time, and then we've gotten it in the interest rate market. I guess we had a little last year. It just didn't actually show up in the VIX. But look, last year we saw exactly what everybody was expecting in order to get us to a soft, not softish, the word we used to use, but soft landing, right? And that was inflation came down faster and in bigger size than was expected. The Fed seems to get behind that and the consumer strength and seems to be leaning towards interest rate cuts in 2024. We remain committed to that there will be interest rate cuts. We think the market, as evidenced by the pullback in those expectations, may be a little ahead of things. And even the data today may change that slightly. But at the end of the day, we have an earnings recession behind us going forward. So even if a lot of the things don't materialize that can send multiples up, we do see earnings that can take especially certain sectors, and often those sectors are the ones that carry the market up enough to see those healthy single-digit returns.
Such as?
In terms of
sectors,
sectors.
where you think either margins or earnings can surprise.
Yeah, so look, we're expecting a 9% increase in earnings this year and a 6% in 2025. Largely, that's tech. That's big tech, right? You're seeing some of those numbers come in at projections of 25 to 30%, whereas you're seeing other sectors that don't have as much weight in the market. Healthcare, you mentioned. Consumer discretionary is one where we feel like the consumer has really held up, but exactly as the banks are coming to us and saying, they're starting to see cracks there. And so if we're looking at the backward-looking data, like the retail data that came, that's, again, the story of why 2023 worked. But what will be that story in 2024 for those sectors?
We heard, some comments in Davos about how the markets have almost shot themselves in the foot. And that's kind of part of the sentiment behind the change in the swaps market, predicting, much more leaning toward a June rate cut versus a March rate cut. Do you think that the market hadn't been helping its, the quest to tame inflation by buying bonds at the end of the year? And that's kind of why we're seeing this more skittishness surrounding the bond markets in recent weeks.
Look, I think that there was a lot of exuberance in December, whether it was fueled by data, it was fueled by a Santa Claus rally, whatever it was. Obviously, a 10% 6-week sort of took advantage or brought forward a lot of the expectations for this year. Now, one of the things, if you think about the bond market and this sort of like game of chicken that traders are playing with interest rates in the Fed, is if you had a year where bonds appreciated, let's say, high single digits, and equity portfolios, which are mostly, and we believe should be, market cap weighted 25%, then right now, when you have historical underinvestment, even at market highs, there's some rotating rebalancing to do, too, which I think is so much why there's sort of like a buyer's strike right now. It's hard to get excited about anything because earnings season has been sloppy. We think, as I talked about, again, it is going to be sloppy and disparate. And so people are sort of in the show me and playing in the bond market before they're really going to get behind equities. And so to Mike Santoli's point, like we had a great day yesterday. We had been using options to get a better entry point in the market. And yesterday we got hit at 4,700. So that's the kind of things that we're doing to thoughtfully, intentionally, and discreetly increase risk a bit.